To invest, I mean, poly-crisis in itself has obviously we have the different factors passing through. But of course, the start of this year, we have got a reassessment going on, obviously, by the markets on what lies ahead, and we are still in the hard landing camp. That this tightening was done on planet Earth, not on planet Mars, and there will be an impact, and it will show up as poly-crisis.
Why do equity markets ignore that at their peril? Because, well, that's the question.
Yeah. No, I think the signals coming from the bond market are at odds with what's happening with the equity market. If you look at the bond market, we have had a significant rally, yields have coming down. It's not just about inflation coming down. What's the cost of that inflation, which is the critical factor for equities? And we've seen that so far the data on the labor market data has been on the stronger side, and that's where the equity market has been focused on. But this tightening will start to have an impact on the consumer, and that's where we think the equity market can potentially come under pressure.
Just to follow up on that one, should our viewers be selling their holdings or even trying to short somehow this market?
So we think that the defensiveness has to keep on building now, right? For example, you are now getting good value to buy left-hand tails. Right. So if tightening starts to pan out more broadly going forward, the transmission mechanisms kick in. We know in 2024 there's a lot of refinancing flows coming in, which will, debt which was raised during pandemic at very low rates will start to roll into very high rates, which the key central banks have put through. We think that this is the time to start thinking about left tail risk hedging.
But it's all right, isn't it? We're going to have a soft landing.
Look, if you look at the last 2 months of data, definitely there is soft landing type of dynamics there. Wage growth slowing down, labor market still is remaining strong. And we'll see what happens in non-farm payrolls report today, as Jeff you mentioned. What will be that combo? But that said, housing market is under pressure. We know that consumer and consumption growth is slowing down, and this tightening will start to broaden out. So this is, and of course I should highlight business surveys. The business surveys are collapsing, especially in the US, which is consistent with the recession probability. So that tension is alive, and we think that it will pay out in the manner of tightening, slowing growth into a recession outcome.
Is there a risk that Jay Powell and the committee feel they need to do another 25 or 50 because markets are resisting the draining of liquidity? Financial conditions are being kept relatively easy by the market's refusal to accept the consequences of the Fed's actions at this point, it seems to me. Does that push us further along the road to higher rates?
So I think now this, the restrictiveness or the nature of the restrictiveness is on how long they keep rates at this terminal rate. Because remember, this terminal rate is far above any estimate of neutral rate. So that means that if you keep central banks keep rates at this higher level, that will keep on damaging the economy. So the way that communication will come through could be that we are not going to cut rates anytime soon, and the markets we know are pricing in a cut by the middle of this year. So that discrepancy they can close, and that will result in tighter financial conditions.